Hello, welcome back everyone to another episode of Let's Talk Housing. My name's Brennan Thomas and I am the co-host here alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today we will discuss the most recent news and statistics, how current times will go down in history, the large decrease in mortgage rates, renting laws changing in California, and the commercial real estate industry. But first, Stephen, what is happening in the Thomas household?
Oh my gosh, 'tis the season. All presents are wrapped underneath the Christmas tree, and we're ready to rock and roll. We start with it's my sister-in-law's birthday, and then head to a little bit of Christmas Eve cheer. Actually, it's my mom, your grandma, everybody's grandmas, because we have lots of kids. Her birthday, and she turns 80 on Christmas Eve. So it's really all about celebrating mom slash grandma, and she's a wonderful human being. So I can't wait to celebrate her more. And then of course there's the big giant shindig over at the in-laws' house. Pappy and Nana, and everybody converges there. All family members. He's one of seven, so all the kids converge there, as well as it's a big, giant celebration, and it's finished with a Christmas Eve mass and just good old time. And then Christmas Day will come, and that's when all the kids will be opening presents, and most everybody will have 8 of the 9 kids sleeping in the house, and then the ninth one will show up in the morning like he always does, and I'm sure there'll be karaoke and things like that, like we always do, and just have a fun time. That's what's planned for us, and then it's just waiting for New Year's Eve, and we always have some little New Year's Eve thing for anybody that wants to participate. How about you? What's going on in your neck of the woods?
I wouldn't say a whole lot. Just more soccer to follow for me. Even tomorrow and over this weekend, which will be Christmas for us, but by the time this is uploaded, we're going to be heading towards New Year's. Still have soccer, which I am so thankful for because I get to wake up on Saturday and Christmas Eve and still be able to enjoy that morning experience. And then at the same time, there's big news of a huge soccer player coming to Miami again. Another person that came from Barcelona, his name's Luis Suarez, and that's going to be exciting for the MLS. So just more good news. But other than that, just ready for the holidays. It's almost unbelievable how quickly this year has gone for me with graduating and everything, and it's already Christmas, and it just feels like the gas pedal is just being pressed on a little bit faster. So it's crazy, but I'm excited for this new year. It should be good. But Stephen, like usual, what's happening with supply, demand, and our expected market time?
It was interesting because the supply actually went up. I mean, down. The supply went down like it normally does. It's been coming down pretty fast over the course of the last month. It really came down. The last two weeks, it just fell like a rock, like it normally does. Now, demand, it was for the week prior, actually from week to week went up a little bit, and that's because interest rates went down so much that we had to eat up all the inventory that was left, because December, there's nothing that comes on the market. A lot of people pull their homes off the market, so everybody was just chasing scraps with these lower rates. So it did have an impact on shortly for demand. But since then, over the last week, now that we're deep into the holidays, demand is coming down because there just aren't that many homes on the market. So, but with inventory coming down way faster than the rate in demand, we've had some pretty significant drops in expected market time. That's the speed of the market. That's how we determine how fast a market is. So in all markets, we're seeing a big drop in the expected market time. So if you were in the market 2 weeks ago as a buyer, and if you came into the market today it would actually feel hotter than it was 2 weeks ago. And here we are right at the end of the year. So it's not until more homes start coming on the market after we rip our way through these holidays where we're going to see some sort of a bit of a change. But until then, The change will be more buyers actually coming in and a few more homes coming on the market, but those will be easily sapped up. So we'll see market times just dive even further after we ring in a new year.
So then, what economic readings have we seen over this past week or so?
So, gosh, we got another the Fed's favorite inflation index actually came out today, and it was lower than expectations once again. It didn't really even move the markets much, but I think I was talking to you about it that there's not a lot of activity going on in the market today, Friday, before a major holiday. So it's like bare bones of anything that's going on. So you can't really see a real direction based upon any big news. But I think that that's really big news because it just continues to show that inflation's really coming down nicely. And I was pleasantly surprised with it. So it was one of those pleasant numbers to get out. So pretty much we've seen everything that's been pretty favorable as far as the numbers have been concerned over the course of the last month. So it's all leading into we've probably hit our top as far as the of the economy is concerned, and it looks like that there's going to be it's going to be coming down a little bit from where it's at right now.
So, mortgage rates recently took the largest dive we've seen in decades. Not only that, but just 2 weeks again, I said how, or 2 weeks ago, I said how just being in the lower sevens was a little bit unbelievable since we were at 8%. It just seemed like a whole lot was going on, but now we are in the sixes officially. So, what happened that caused such a large drop in rates?
Yeah, it's fascinating to see how excited everybody is about sixes. If I would have told you last year that you'd be excited when interest rates got back into the sixes, you would have gone, "You're crazy." But yes, that is exactly what has transpired, and it's the Fed. People are calling it the Fed pivot. I think I'm even have called it that. It's kind of like they're pivoting in their language. Their language has definitely what was different. Their speech was different. They pulled out this big piece of their speech at the beginning, everything with that was a lot more hawkish, and they pulled that out completely. So all of a sudden the flavor of the speech that they all agree on, and then the Q&A afterwards that Powell did was very it was a lot more dovish, which means that they're not as they're not as steadfast on how they're going to inflict pain on everybody. And then as a result, and then the Fed dots came out as well. So we get those dots. That's where they think short-term rates should be. They come out every quarter. Well, the last time we got one was in September. Then we got one in June. So there was one in June, then one in September. And every single time they were cranking it up higher and higher as to where rates would be the following year. And this time, going from September to December, all of a sudden they cranked it down. And they said that rates will be 0.5% lower than what their expectations were just 3 months prior. And so immediately markets said, finally, what the Fed has said is they're done. And not only that they're done, that they're going to be making some rate cuts next year. And their answers to questions kind of painted the way to why. They're overly restrictive. And there are a lot of very, very smart people that are coming out saying the same thing. They're way too restrictive. And when you're this restrictive and we have inflation that's coming down nicely, the difference between where inflation is and where their rate, that short-term rate is, it's too big of a gap. And it's such a big gap that it's putting too much pressure on the overall economy. And if you put too much pressure on the economy, something's going to break, and it's not going to be good if you continue to be higher for longer, like they were talking about. Now they're talking that they need to bring this thing down so that it's at a bigger, a smaller gap between where inflation's at and where their short-term rates are at, and this is what they're alluding to, and that's the way all their Q&A and everything else was. So what we did is we saw not only did we see a flood of cash come into 10-year treasuries and 30 and mortgage-backed securities, we saw interest rates then fall because of that. And also we saw a load of money go into the stock market, and people are going, that's amazing that the stocks are going crazy. And that's part of that is because there have been people that have been sour on builders. There's a lot of different stocks that are they have a little bit more exposure to higher rates. With rates coming down, all of a sudden those stocks are looking good, so you have a lot of money that's flooding those stocks. So that's also a big piece of it. So car industry as well. If they're going to be coming down, it's better for the car industry. So there's a lot of different points where, so we saw everybody go nuts. And as a result of that, we saw that there was a couple of Fed presidents that said, hey, you know what? I don't understand what the overreaction was from the market. It makes absolutely no sense. We didn't really talk about rate cuts. Yet they changed their language completely. A, they changed their language, and B, they changed their dots to go along with that language. So even they can come back and try to backpedal like they typically do when they're trying to keep markets under control, because they don't want them all of a sudden the stock market to go crazy, as well as interest rates come down a lot. So then all of a sudden it's doing the opposite of what they need. Then that's why they're coming out and saying ridiculous things. Somebody came out on Friday and said it, and I think another Fed president came out on Monday and was beating the drum of that. And it was just actually, they need to stop talking. We already knew that, markets knew it, and you saw the rates come down, and then they've been staying around the same level all week long ever since then. So it's not really changed much, even with the Fed saying that they're trying to walk back what they're saying. So this is actually great news for everybody. I love seeing a six handle. It leads right into what we've already talked about as far as where we can go for 2024 with rates. And for many people, where we are on rates is where they thought we'd be during the third or fourth quarter of 2024. And we're here already.
It was definitely interesting to see how the Fed reacted to the markets changing and everything. But what I wanted to ask you is, are you able to see anything in at least the Southern California numbers? Has the housing market reacted in any sort of way that's recognizable?
Yeah, like I said, so since we're nerds and we like to do this every week, even though we don't put out a report every week, there are the markets that we do. It's every other week. But of course, we're pulling numbers for every single market on a weekly basis, just so we could see where we are. And fascinating. And we actually tweet that out now to our subscribers. We not tweet it out. We text it out to all of our subscribers if they want it. They could just, they have to make sure that they want it, and then they let us know that they want the text message. And so we're giving them the actual numbers on a weekly basis because we were following it anyways, and it's good to know where we're at. So what was interesting was last Friday in a lot of markets, I think Orange County had the exact same demand when typically demand's dropping, and like San Diego County demand was up. For the most part, what we saw was either it was up or it was flat or just down just the tiniest amount from week to week. That's not normal. Normally, what we have during the holiday market is you have demand falling, inventory falling at a pretty good clip. So demand's already been down all year long, so it's been kind of flat. But we still, even last year, saw that demand was coming down at this time of the year. But the reason that we had demand going up or flat or down slightly is because of rates dropping like they did. We could actually see immediately that anything that was out there was being zapped up almost immediately. And agents were talking about how they had a house that was sitting there with no activity, and they reduced the asking price, and then finally getting a few little more activity, and then the rates dropped a lot, and then all of a sudden they got like a bunch of offers, and they were they were bidding on each other, and then they ended up getting the exact price that they started off with prior to the price reduction. And I'm hearing lots of those stories that are out there because there's not a lot of homes available. So in the last week, yeah, we had demand come down, but you have to understand the demand's coming down because there's nothing coming on the market right now. This is not the week for homes to come on the market. So instead, we have a lot of people traveling and enjoying the holidays and that type of thing. So it's very hard to read in this market, but we were able to see little pieces that show us exactly what to expect for 2024 for the start. If you're expecting to take your time because it's the winter, you're wrong. It is going to be extremely hot and busy because we have low rates finally. And going from 8% in October all the way to where we are right now is adding millions of Americans that can now finally afford to purchase a home that were pretty much they were cut out of the market because rates went too high. So that's what we're seeing in the data locally and everywhere that we track.
So I know that mortgage rates are obviously extremely difficult to predict and try to see where they're going. But do you have any idea of where they could be going, at least for the rest of the year or just short term in general?
Yeah, well, for the rest of the year, there's not a lot that's going to happen. We know by the economic data that's going to come out, and these are a time frame where not a lot of people are working, so there's not a lot of purchasing, and investors aren't going crazy. A lot of people just want to relax. It's been a wild ride in 2023, and you just want to get off in it and sip on some eggnog and mingle with some friends, that type of thing. So that's what we're kind of dealing with. It won't be until we get till after that first week of January, second week of January, we really get into the market will start to buy. People were anxious to get past the holidays, pull all the holiday stuff off of the shelves and off of the house and all that stuff, and put away the boxes and then go on with their lives. So when that happens, then we'll be able to see a material change, and then we'll be able to see what's going on with jobs for December and different things like that. So there's a lot of things that will come out that will move markets that we will be watching. But what we anticipate is this slowdown to happen, and the slowdown in the economy. And I tie up more to the consumer than anybody else. And some of the numbers are really perplexing. It's the savings rate of Americans across the United States. It's the depletion of the excess savings from all the stimulus that's out there. And then on top of that, we have credit card debt that has been ballooning. Normally credit card debt goes up over time, but I don't like the recent spikes that I've seen. It's not a good trend. So you combine all of that together, and it equates to consumer spending that will slow sometime in 2024. And we're trying to put our finger on it. Does it happen by spring or does it happen in summer? We used to even talk about, will it happen in fall? And we're already starting to see it in the numbers, and we're seeing inflation coming down, so that we could watch rates come down a little bit sooner than we thought. So we're primarily baking in that it's going to happen within the first 6 months of the year, and so that's when we see that rates will have their pathway of coming down. And what I mean by coming down is we're at 6.65. The next level is going between 6 and 6.5%, getting down to the low sixes. And is there the ability to get into the fives? We actually think that yes, by the second half of next year, that we'll be looking at something in the fives, just anything in the fives. 5.9 sounds delightful compared to the 8% that we were dealing with just for a short period of time, but it was enough where it makes you really appreciate five.
So on Monday, December 18th, we saw the lowest spread between the 30-year fixed mortgage rate and the 10-year Treasury in quite some time. What does that mean?
It's got to come down from. I mean, the spread was as high as 3%. It was, holy smokes, that's ugly. 3% is spread. Now you have to. There's this love affair between the 10-year Treasury and 10-year Treasury and 30-year mortgage rates, and it goes back in time. It has to do the investors with 10-year Treasuries is the same investor for mortgage-backed securities, and that's why it goes together, kumbaya, since 1972. So this has been going on for a long time. Now the average spread between where the 10-year and 30-year mortgage rates are going back to time is 1.75. And so 1.75, it got all the way up to 3. It's come down since then. I think that article was based on it was about 2.7. What does that still tell you? We're still 1% higher than where we should be. we should have interest rates that are already in the fives. The reason we don't have them in the fives is because of all that uncertainty and where are we going and all that stuff. So until things are more certain, when we have inflation coming down and we're past all of the COVID gyrations in our marketplace, we haven't had a recession, and a lot of the things that should have happened, the quotes should have happened, did not happen because of the disruption of COVID. COVID was such a giant disruptor that it makes some people think that even though the Fed did all that they did, that inflation would have come down anyways. There's a lot of people who are now looking back and arguing that point, that it truly was transitory. It's just, it's taken a long time to come out of the wash. And where it's coming down nicely now, the spread will, once we're past all of the volatility in the marketplaces and the uncertainty in where all the different numbers are going to be in the future, and it's a little bit more of a predictable path, then we'll see that spread start to shrink more and more. And that's just going to take time. So that spread will shrink over time. It's just gradually. That's good news that we see it lowest in a long time. Now I'd like to see it be less than 1%. I'd like to see it get to 0.75%. That'd be in the next, then 0.5%. And we know we're going the right direction. And but we'll be watching that. Hopefully there'll be a lot more of that to come sooner rather than later.
So, Stephen, what I want to ask you is, why is it dangerous to try and time mortgage rates to be most beneficial to someone who's looking to purchase a home?
Yeah, because I just said it, uncertainty. So with this much uncertainty in the market, there's a real issue with trying to time it, because you can get one job data or a jobs report or a CPI report that doesn't match with trend lines. And when it doesn't match, what happens to rates? All of a sudden rates go up, or all of a sudden then we can have another problem where now the job market gets too hot. Now it really is weighing on inflation. Inflation starts to go up, and the Fed has to do more, and they have to start hiking rates again. You just lost out on an opportunity. When was the opportunity? Now. So it's always the way that I look at it, is if you got to look at right now. As far as now is concerned, today's rates and everything else, you get into the market. If you can afford to do it, pull the trigger and do that. And know that down the road, that if everything goes the way that we're talking about it going, then you know what? We're going to see rates that are lower. You can actually refinance down the road. There are people that just got into homes. We had 8% interest rates. They were closing in October, 8%. And here we are at 6.65%. Guess what? They can already refinance their homes. And which isn't good for the lenders. However, it's great for the consumer, because it is a significant savings. It's from 6.65 to 8%. So down the road, if it goes the way that we're talking about and it goes smoothly, which are we saying with 100% guarantee that that's the direction it's going to go? No. So that's why you got to make sure you can qualify right now. Know that down the road you can refinance if things go the way that they should. But you should be happy with the rate that you're at right now, and you qualify and you go purchase something. And that's what we do. And if you're able to do that as a family, then go do that. Only you know that for your own family or for yourself, if it works out for you. If it's not a good time and it doesn't pencil out, well then maybe you have to think of something else. And I've talked about it with millennials and Gen Zs and the Gen X, Generation Xers. Everybody out there, there's different pathways to think outside of the box, and that's renting out a room, buying a duplex. There's different things that we've talked about. So don't be too discouraged by a mortgage rate. Just see what you're able to do and then pull the trigger.
So with mortgage rates dropping recently, can anything change in a positive direction with the commercial real estate industry?
Yeah, well, they really have to come down, because you have to remember the short-term rate was at 0 before. So it's at 5.5 right now. So they haven't even made that significant of a change yet. So yeah, rates may have relaxed a little bit, but we need to see that rates come down quite a bit for there to be a lot of relief in the commercial sectors. The commercial sector is still going to be some headwinds. but there will be some relief. Things will be able to start to pencil out when they have to get a new loan, because you don't get a 30-year fixed loan on a commercial building. You have to go out and get a new loan because they're only for a certain term, and then you have to go get a new one. So now, if rates come down a bit next year, yeah, you know what? They're getting a little bit of relief. And then they've got to look at, well, what's that payment look like? Am I now, does this make sense, this investment? For some people this year, it didn't make sense. And we had people walk away from their commercial obligations and just turn it over to the bank. So there will be some of that. So right now we're at a 10-year high, a decade high of commercial foreclosures and distress that's out there. But we'll have to see. There will be relief, but will it be enough? Probably not, but it will be some relief going forward.
So the commercial real estate values will suffer a $480 billion wipeout next year, and that's following a $590 billion loss in 2023. What do you expect will happen over the future with the commercial real estate industry based off of these statistics?
Yeah, so things have really slowed down in there. But it'll rebalance out. I mean, it's going to get to a point where when you're wiping out part of the market, you're wiping out the total value of the commercial, all the commercial properties put together. Values have been coming down, and as they come down more and more and more, it'll get to a point where suddenly it looks a lot better. I mean, like residential real estate, it's gotten a little bit out of hand. It's a little bit different on the commercial side of things, because there's not the big supply issue like there is in residential resale. So there's not a contagion where all of a sudden what happened in commercial is going to happen in residential resale. It's got to get to a point where the prices come down, where there's more people that are now interested and ready to enter. So yeah, it's the supply and demand and where prices are at, where it comes down to a point where we'll start to see that will become solid as far as where values drop down to. What that value is, I'm not following commercial close enough to know exactly what that is, but that's also a supply and demand issue.
So I read one real estate agent, as like he wanted to describe 2023, he said it was the year your first home accidentally became your forever home. So Stephen, how would you describe 2023 with everything that's happened?
Yeah, well, it was for the year, when you have interest rates that are as high as they are and you're locked into these low mortgage rates. Well, there are a lot of people that this isn't their first home, so that was that person's anecdotal story. But there's a lot of people where what they're trying to say, if you were a first time home buyer, this became your forever home. You know what? No, I'm not buying that, because I've seen that over time, and I know no, we've had 18% interest rates in the past before, and people thought, oh, we're never going to move, that type of thing. Yet they did. So yeah, that's the way it feels right now. Does that mean that you might be holding your home for longer? Yeah, probably. But as interest rates come down a little bit, or you're making more money down the road, it'll become a totally different story. And as values continue to go up, you'll go, I can still move, and this isn't a big of a deal if I get this kind of a payment, down the road. So, no, not a forever home. I'm not buying. I'm not buying that. That's the way it feels, and that's what they're articulating, but not necessarily true.
Now, from COVID to supply chain issues to the bank failures, a lot has happened over the past couple of years. As you like to say, we are in uncharted waters. I like the traditional setting and just calling it that we are making history. Whether it has to do with COVID, economics, real estate, and most things in general, history is being made month by month. I know this also creates uncertainty for future predictions, but how does this affect us trying to make predictions moving forward?
Yeah, I like the term trendless, because it's trendless. People like to, I've said it before, people like to stick economics in a box, and you really can't fit this time period in a box, period. But we can look at enough trend lines to know where things are going, such as inventory, supply, For housing, that's a trend line that's pretty much guaranteed. CPI and all the other PPI and all the other inflation indices coming down nicely trend. So there's different trends that we're following that we can see with certainty that things are going the right direction. So we're looking at that, but it's still as far as trends of recessions and things like that, it's that is where we don't quite see eye to eye. Everybody's kind of like we're looking in the dark. But the longer we go on and things start to go more towards normal, and we get towards inflation coming down normally, and the inversion between the 10-year and 2-year treasuries, they no longer being inverted, and different, and unemployment rising a little bit, and different things like that, where we'll see things working out. That's where we're going to be more in charted waters down the road. It's just, when are we going to get to where there's a little more certainty? I think we're going to have to make our way through another year of this before there's a bit more certainty. And I'm hoping that we get there by the second half of 2024. And that's kind of what we're thinking, where things are headed, is there'll be a little bit more certainty by the second half of next year. But until then, still up in the air. We're just looking at small little trend lines and things like that and different areas to properly forecast where things are going.
So I know that you've discussed this topic already in your forecast video that you just released last week. So everyone, if you haven't checked that out already, please go and take a look, because it is some great information. But what is your most likely outcome for the housing market in 2024?
So my old analogy is that empty peanut butter jar. We're at the bottom of the peanut butter jar as far as inventory is concerned. So which direction for inventory? Most likely up, but we're still going to be dealing with a very empty peanut butter jar for inventory. I'm so sorry. We're not getting a full jar of peanut butter anytime soon. But demand, for sure. That is, we've reached inherent demand levels. So there will be more homes available, but where are they going to go? They're going to go right into pending status, so which will create a very limited inventory. As far as total numbers of homes that are have been on the market and pending, those are going to rise, because we're actually seeing the number of homeowners that are coming on the market, that it too hit a really low bottom of that peanut butter jar. And now we're actually starting to see more peanut butter. We're seeing more homeowners coming on the market than the prior year. For the United States, there's more in October, slightly more in November, a little bit more, but we're starting to compare year over year, where last year at this time, this is where it was pretty deep. Not a lot of people coming on the market. So to see that there's more than last year is a good sign. And we're going to see this coming up year, when we're looking at year-over-year statistics, is we're going to see more peanut butter and peanut butter jar as far as homes coming on the market. And then we're going to see a rise in demand with these lower rates and more pending sales, so which will translate to more closed sales. That's what we're going to deal with. More pending sales, more closed sales, more homes coming on the market. Is it going to be like out of this world? No, we're coming from a bottom. It's only up from here. Yeah, but the one thing we're still going to have this inventory issue for quite some time. It's not going away. I do not see a flood of homes coming on the market and remaining on the market, not sitting there. They'll be gobbled up by the increased demand with lower rates.
So NAR is projecting that existing home sales will rise 13.5%, or 4.71 million homes, and new home sales could increase by another 19% by the end of 2024. Do you think that this sort of projection is likely to occur?
Yeah, because they're dealing with the whole Oops. Hit my lights. They're dealing with the whole United States, all of the United States. So that kind of an increase is actually a large increase. When you start looking at smaller markets, the increase looks even larger. When you're dealing with these smaller numbers, the percentages look great. So the bottom line is more homes. That's what they're saying. We totally line up with that. I think almost everybody is in that same camp, that we're going to deal with more closed sales. I totally agree with them. The exact percentage, we all deal with our different trend lines. We all have different ideas, and mine is down to the decimal point too, as well. But we have our ideas, and it's just going to mean more next year.
So, looking at those sort of statistics, how far off would you say will we be from the pre-pandemic home sales levels?
Yeah, we're not going to make it to pre-pandemic levels yet, but we're definitely going to come off of these bottoms. These bottoms are very reminiscent of the Great Recession levels as far as closed sales. So homeowners are fine; they're not being foreclosed on and aren't distressed. However, we're just doing fewer closed sales. So it's up from here. It's better than this year. It's better than the Great Recession, but it's not a lot like it was prior to COVID. So it's like it'll be nice in the middle, but it'll be a good start.
So, according to Yahoo Finance, a wave of inventory could hit the housing market in the coming year as 24 million homes present an opportunity for fix and flip investors. Can this really create inventory, or would it just create more turnover due to there being newly renovated housing?
That is um, that is really dumb. Saw this article. Makes no sense. That's not adding to inventory. That's actually fix and flip is you go purchase something that's available and you fix it up. You're taking it away from somebody else that can fix it up themselves, and then you sell it at a higher price for a profit. So fix and flip is not going to add it at all to inventory. I thought this is a horrible article, and I'm glad that we can show that this is not a pathway to more homes coming on the market.
So, according to Axios, the Phoenix Valley tracked just over 64,000 sales so far this year, the lowest annual tally since 2008, when the housing market crashed. In 2021, we saw more than 100,000 sales. What are you currently seeing in the Phoenix market?
Well, 2021, yeah, that is like saying this is the height. Well, that was higher than all the years prior to COVID, dating back to prior to the Great Recession, 2005 numbers. So that's like is like a bait and switch, like scare tactic. The 100,000 was a bit on the ridiculous side, based upon all the homes that we were building and that people stay in their homes for longer. And 64,000 is low. It's just like what I said. Same thing that all the numbers we're tracking. We're like at Great Recession levels. That's just what this is as far as units. Does this mean we crashed? Yeah, in sales, not in home values. So it's just it's an article for clicks. But it's up from here. It's up from 64,000 sales. It'll be up next year.
So, some recent breaking news: the state of California had some renting laws changed, with the governor signing a bill that limits security deposits equivalent to 1 month's rent, and tenants cannot be evicted based on alleged criminal activity. They made it harder for landlords to evict tenants under the no fault, just cause policy. All these will become active in January of 2024. So just a couple weeks away, but by the time we release this, just 1 week away. Can this benefit affordability in those trying to live in California?
Uh, yeah. The out of all of those, uh, California is very pro renter, and it doesn't line up that favorably for landlords. So there are a lot of these things where when you peel back, you're going, I wonder why they're doing this. But one of those that stands out to me is the security deposit. Uh, you know, when there are so few like single family rentals that are available, uh, it makes it hard when there's a lot of demand for rental housing, and yet only the richest are able to get it because they're requiring this giant deposit, and only this wealthy person can come in. It's kind of like really separating between the haves and the have-nots, and it's just absolutely not fair in this tight of a market. It's like kind of like when there's so few homes available, and these these hedge funds are purchasing homes away from people. It's kind of like that too. Is something else that we realize is a bit unfair when who's the one that's losing out on this? It's the people that are still able to afford to do it, but they're losing out on the people with all the money. So it's the difference between the haves and the have-nots. Now that I'm for that, we need to do some a better thinking on, and I think that addresses it. But they, of course, they package it all together and they put a whole bunch of different things on there. So now if you have a criminal record, you can't evict somebody based upon a criminal record, which I kind of understand, but it just depends upon Are they paying their rent, and do they qualify? Do they have good FICO scores? Do they have a good job? That type of thing. Well, then if they qualify and all that stuff, just because you have a criminal record doesn't mean that you can't ever be able to rent at all. If you put yourself together and you have good credit and all that stuff, why should you be penalized? And so that's just another one of those. It just depends upon exactly how it's worded. I haven't seen all the wording on it, so some of these just make intuitive. You got to think with your brain and what's fair, and just go from there. That's how we deal with things. I don't like to say it's one side of the aisle or another side of the aisle. I like to say, okay, what's probably the most fair thing out there? And this really looks like it's burning a certain person that's out there, and that's what we have to be careful with.
Awesome. Well, I'm going to conclude today's episode. Thank you, everyone, for tuning in again to Let's Talk Housing. Now, if you want to learn more about what's going on in the real estate industry across Southern California or the Bay Area, and I won't forget this time again, Ventura too, which is really cool. Feel free to check out our YouTube at Reports on Housing, or you can go to our website, which is reportsonhousing.com. So please leave us a good review. And if you have any questions at all, just leave it anywhere in our social media, or you can email me at info@reportsonhousing. Happy holidays and happy New Year's to everyone. Thank you.
Thank you.